Welcome to Kiki's Talk Buffet. Let's talk it out.
You know that feeling, right? When you look at your paycheck and just, wow, a big chunk vanishes.
Mm-hmm. Tax season hits.
Exactly. You work hard, and then poof, a significant amount is gone. Ever feel that sting? Okay, so today, let's maybe unpack why that might be happening, at least according to one perspective.
We're going to explore a different way of looking at it. Yeah.
For this deep dive, we're jumping into the history of taxes and the power of corporations. We're drawing mainly from the book Rich Dad, Poor Dad.
Right. We're focusing on the parts where the author really digs into, how taxes work and how corporate structures might change things for you financially.
Exactly. The mission today is really to get inside the author's viewpoint, why he believes the middle class shoulders such a heavy tax burden, and how he sees corporations as maybe a potential edge.
It's about getting a different take on wealth building, understanding the rules of the game, maybe, as he lays them out, anyway.
Totally. So where does he start this whole discussion?
Well, he brings up a figure we all know, Robin Hood.
Ah, Robin Hood, the
Yeah.
good guy, right?
Generally, yeah. We think of him as, the hero. Steals from the rich, gives to the poor.
That classic image. Seems pretty noble on the surface.
But the author shares his rich dad's perspective, which was, pretty different.
Different how?
He didn't see Robin Hood as a hero at all, called him a crook.
A crook? Wow, okay. That's a strong take. What's the thinking there?
The author argues that this whole Robin Hood fantasy, this idea that taking from the rich to give to the poor is the way to go, he says that's actually a big reason the middle class ends up paying so much in taxes.
Hold on. So the idea of helping the poor leads to the middle class paying more. How does that work? That sounds kind of backward.
Well, his argument goes like this. The idea might be to tax the rich more heavily, right? Progressive taxation.
Yeah, that's the usual justification.
But in his view, what actually happens is often different. He suggests the rich, they often find ways to navigate or minimize those taxes legally.
Okay.
And so the burden doesn't really land where people thought it would. It kind of shifts.
Shifts onto the middle class, presumably.
That's his contention, yeah. That it ends up falling more heavily on the middle class and even the poor.
Huh. That's definitely provocative.
Yeah.
So, to understand that better, we probably need to look at the history he talks about, right? The history of taxes.
Exactly. He points out that historically, permanent income taxes weren't really a thing in places like England or America.
Not always the norm.
Not at all. Taxes were usually temporary levies, for specific things, big events, mostly wars.
Like, give me an example.
Well, think about Britain during the Napoleonic Wars or the U.S. during the Civil War. They raised taxes, but the understanding was this is temporary just to fund this effort.
Got it. So very different from the system we have now where it's just expected every year.
Absolutely. He notes it wasn't until 1874 in England and then 1913 here in the U.S. with the 16th Amendment that income tax became, permanent.
And he mentions the Boston Tea Party too, right? As an example of early anti-tax feelings.
Yeah, he brings that up to highlight just how strong that anti-tax sentiment was initially in America. I mean, a tax on tea literally sparked a revolution.
Really puts it in perspective.
Okay,
so taxes become permanent. What's his key point about how they became permanent?
this is crucial to his argument. He says these first permanent income taxes were sold to the public, to the masses, with one specific promise.
Which was?
That they would only apply to the rich.
Ah, okay. So the pitch was, don't worry, this won't affect you, the average person. This is just to make the wealthy pay their share.
Exactly that. And because of that promise, the idea gained popular support. People thought, great, the rich will finally pay.
But I sense a but coming.
Right. The author argues that this strategy totally backfired on the very people who supported it.
How so?
He claims that once the government got access to this new river of money, its appetite grew.
Ah, the quote from his rich dad, right? Once government got a taste of money, its appetite grew.
That's the one. It sums it up perfectly from his perspective. The need for revenue kept increasing.
And so the definition of rich started to expand, or the tax rate spread downwards.
Pretty much. The government needed more funds, and eventually the taxes started hitting the middle class and the poor, the very groups who were initially told they wouldn't be affected.
That's quite a narrative.
Yeah.
He also contrasts government and business goals, doesn't he? Based on his two dads.
He does. He talks about his poor dad, the educated government employee, where success often meant, a bigger budget, more staff under him, more spending.
Right. Growth equals expansion.
Whereas his rich dad, the capitalist, was focused on the opposite: efficiency, keeping costs low, saving money, investing it wisely.
It's a fundamental difference in mindset, isn't it?
Mm-hmm.
Government looking to spend and expand services, business looking to save and maximize profit.
And having these two very different influences shaped his whole view on money and systems.
You can see how it would. Okay, so this brings us back to the rich. If the taxes were initially aimed at them, how did they, according to the author, manage this? This is where corporations come in.
Exactly. He says the rich didn't just sit back and pay, they adapted. Historically, they used the idea of corporations. He uses the example of old sailing ship ventures.
Sailing ships, how does that connect?
Well, imagine investing in a risky sea voyage back then. Instead of putting all their personal wealth on the line if the ship sank,
They'd form a separate company just for that voyage.
precisely, a corporation.
Hmm.
If the ship went down, they only lost the money invested in that specific corporation. Their personal assets were protected. It limited their risk.
So it creates a legal shield, a separation between personal wealth and business risk.
That's the key. Understanding that a corporation is a legally distinct entity. That's the advantage. It's not part of your personal income statement or balance sheet.
And he believes this understanding allowed the wealthy to, well, to outsmart the system in a way.
That's his phrasing, yeah. As the government's need for taxes grew and started hitting the middle class, those who understood corporate structures, the true capitalists, he calls them, used corporations for protection and advantage.
Okay, so let's demystify this a bit. When he talks about a corporation, what is it really? Is it always a huge building with a logo?
Not at all. He emphasizes it's not necessarily a physical thing, it's fundamentally a legal structure. He describes it almost like a file folder.
A file folder.
Yeah, a file folder with some legal documents in it, registered with the state. That's it. It creates a separate legal person.
Okay, so it's a legal tool. What are the main advantages this tool offers, according to the book?
He highlights a few big ones. First, often, corporate income tax rates are lower than the top individual income tax rates. That's a direct saving.
Lower rates, got it. What else?
Second, and this is huge, the ability to pay for certain legitimate business expenses with pre-tax dollars.
Pre-tax, okay, explain that. How does that work differently?
Well, as an employee, you earn money, pay tax on it, then you pay for things like your car, your vacations, maybe your health club, out of what's left.
Right, post-tax spending.
But with a corporation, certain expenses deemed necessary for the business can be paid before the tax is calculated on the profit.
Can you give some examples he uses? Because that sounds potentially very beneficial.
Sure. He gives examples like having board meetings in desirable locations like Hawaii, assuming it's a legitimate business meeting, of course.
Okay.
Deducting expenses related to a car used for business. Even things like health club memberships, if argued as necessary for executive health, or portions of restaurant meals where business is discussed.
Wow. So the corporation spends this money first, reducing its taxable income, and then pays tax on what's left over.
That's the basic idea he presents. It's about structuring things legally so that expenses are paid before the taxman takes his cut.
That's a very different flow of money. And there's also
Yeah.
protection, right? Legal protection.
Absolutely. That's another major pillar. In our, let's say, litigious society, a corporation acts as a shield.
How so?
If someone sues you personally, it's generally harder for them to get at assets held inside your corporation. And vice versa, if the business gets sued, your personal assets outside the corporation are typically protected.
So it walls off different parts of your financial life. He has that phrase, doesn't he? Something about controlling everything but owning nothing.
Yeah, exactly. The idea is that the wealthy might structure things so they control assets through corporations or trusts, but don't necessarily own them directly in their own name. This offers protection.
Which he contrasts with the poor and middle class who, in his words, try to own everything and lose it.
Right. Lose it either to taxes or lawsuits or creditors because everything is tied directly to them personally.
This all circles back to a major theme in the book, which is financial education.
Definitely. He argues pretty strongly that it's the uninformed, the people who don't understand these rules, who end up getting the short end of the stick.
Because they're playing a game without knowing all the rules or the potential strategies.
Exactly. Think about it. He points out many people work for months out of the year, maybe January to April or May, just to cover their taxes.
Yeah, that tax freedom day concept.
Right. And they might not realize there are legal ways the wealthy use to minimize that burden. They don't just passively accept taxes, they actively plan around them.
He mentions specific things like
Yep.
Section 131.
Yeah, Section 131 of the tax code. It allows you to sell an investment property and roll the proceeds into a new similar property without paying capital gains tax immediately. It's a tax deferral strategy.
A legal tool, but you have to know about it and how to use it.
And that's the thing. The wealthy, he points out, usually have accountants and lawyers who know these rules inside and out. The average person often doesn't have those resources.
It really hammers home his rich dad's point. Knowledge is power, especially financial knowledge.
Being financially smart, understanding the system, means you're less likely to be, as he puts it, pushed around by taxes or financial predators.
It's about being proactive, not reactive. And it connects to that other piece of advice his rich dad gave him, challenging the get a good job mantra.
Right. The counter was, why work for the ladder? Why not own the ladder?
Own the ladder, meaning own the business, the structure, the corporation. He talks about his own experience doing this, right, while still working.
Yeah, he formed his first corporation while he was still an employee at Xerox. That was a turning point for him.
How so? What changed?
He started focusing on minding his own business, meaning building his asset column, the things that generate income, often through his corporation rather than just relying on his salary.
And he tells that story about the Porsche.
He does. How eventually his corporation bought the Porsche using pre-tax dollars because it could be justified, presumably, as a business-related expense or asset within that structure.
It's a very tangible example of the difference in how money can work. Okay, so he ties all this knowledge together into what he calls financial IQ. What are the components?
He breaks it down into 4 key areas. First, accounting, which is basically financial literacy, being able to read and understand numbers, financial statements.
Okay, step 1. Understand the language of money.
Second, investing. The science of making money make more money. Strategies, vehicles, risk management.
Making your money work for you. Got it.
Third, understanding markets. Knowing about supply and demand, market conditions, economic fundamentals, maybe even technical market trends. What makes prices go up or down?
So knowing the environment you're investing or operating in.
And fourth, the law. Specifically, understanding the tax advantages and the legal protections offered by structures like corporations. Knowing the rules of the game.
Accounting, investing, markets, law. And he stresses that it's not just knowing one, right? It's the combination.
Exactly, the synergy. Knowing accounting helps you manage your corporate expenses legally. Understanding markets helps your investing decisions. The law provides the framework for tax advantages and protection. They all work together.
And this leads to that fundamental difference in cash flow he illustrates.
Right. The typical employee pattern. Earn money, pay taxes, spend what's left.
Earn, tax, spend.
The pattern for a business owner using a corporation, as he presents it. Earn revenue in the core, spend on legitimate business expenses, pre-tax, pay taxes on the remaining profit.
Earn, spend, pre-tax, tax. It flips the order for a portion of the money.
That's the core advantage he highlights. So his recommendation really is for people to learn about these legal entities, these corporate structures, and the protections they can offer for businesses and assets.
It's about seeing it not just as something for huge companies, but as a potential tool for individuals building wealth.
Precisely. Shifting from just being an employee focused on a paycheck to potentially being an owner focused on building assets within a protective and potentially tax-advantaged structure.
Okay, so let's quickly recap this deep dive, drawing from Rich Dad, Poor Dad. We've touched on the author's view that the sort of Robin Hood ideal, perhaps unintentionally, led to higher taxes for the middle class.
Right. We looked at the history, how income tax started, aimed only at the rich, but then expanded once the government got used to the revenue.
And then we really dug into his arguments about the power of corporations, not just as businesses, but as legal tools for potentially limiting risk, managing taxes, using pre-tax dollars for expenses, and protecting assets.
And the critical importance he places on financial education, understanding accounting, investing, markets, and the law to navigate this landscape effectively.
Now, it's really important to state again, this has been a deep dive into one specific perspective from this particular book. Finance is complex, there are many viewpoints, many regulations.
Absolutely. This isn't financial advice, it's an exploration of the ideas presented in the source material. But they are definitely thought-provoking ideas. They challenge some common assumptions.
They really do. And that leads us nicely to our final thought for you, the listener. Consider this. How might really understanding the incentives, the rules, the structures of the financial world, like the ones discussed today, how might that change your approach to your own financial future?
Yeah. What new questions does this bring up for you about how wealth is built, how taxes work in your own life, and maybe what options you haven't considered before?
Definitely some food for thought there as you think about your own path forward.
Every topic's got a taste, so like, share, and subscribe now. Your next plate's coming soon.